Hey, Steve Saretsky here. Welcome back to the show. For those of you who have been following this channel for the last number of months, you'll notice that I've been really kind of highlighting three key themes. There's really a recurring theme. We've been covering several topics, and we really got affirmation of those themes this week that I really want to highlight. So I'm going to walk you through the three themes and then go further into detail on each one. So again, the first three themes are: the Fed is going to cut rates, but probably not as much as the Bank of Canada. Number two is the bond market. While interest rates might be moving lower, the bond market might not cooperate. And number three is the Canadian dollar being the release valve for the economy. Basically, it is going to be the sacrificial lamb. And so, again, I want to walk you through those three ideas because I think we got confirmation that they are playing out as we thought they might over the last number of months. So the Fed this week, the U.S. Federal Reserve, post-election, the orange man's back in. The Fed cut 25 basis points, but it was really the tone of the cut that really caught my attention, which is it was almost kind of a dovish press conference in the fact that they basically said, listen, we're cutting, but we want to have optionality moving forward. We want to keep our options open. So it's less of this rhetoric of like, hey, listen, we're really going to aggressively cut rates here, to like, hey, listen, we're going 25 and we're going to sort of watch moving forward. We want to keep our optionality. So I think what this ultimately means is the Fed just isn't going to be able to cut that much. And they're definitely are not going to be cutting anywhere close to what the Bank of Canada is going to be doing. I think particularly when you see the results of the U.S. election. Again, you might not like the orange man, but I think the reality is this guy is pro-growth. He's got an agenda. He's going to go in there and he's going to implement it. Just like we saw his last time he was in the White House. For the last 4 years, what he is. He's a pro-growth, deregulation, lower taxes, stimulate the hell out of the economy. And so, if you're the Fed, I think you're probably going to be monitoring that moving forward. So, again, Fed's cutting, probably not as much as the Bank of Canada. That one remains intact. You move to the bond market. Again, we see this in anticipation of what was likely Trump getting back in, is we saw the bond market moving in advance of that. And what we've actually seen is sort of the bond vigilantes post the Fed cutting rates. Basically, the bond market is saying, I don't know if you really need to cut rates. We actually think that maybe inflation isn't quite going away. Maybe growth isn't that bad. And so if you look at what's happening to, for example, the 10-year treasury yield, it's actually been pushing higher and higher ever since the Fed cut. And so this is the bond market's way of pushing back against the Fed. And this is why I said for Canadians, what that means is it's going to drag Canadian bond yields higher with it. And so my concern is that, yes, the BOC might continue to cut the overnight interest rate. And in fact, I don't think this might. I think they're going to continue to cut interest rates. But the fixed rate mortgage market, which is influenced by the bond market, which is influenced by our neighbors to the south, is going to drag bond yields higher. So your fixed rates might not get much cheaper. And we've been talking at length about that reality. And so, it's interesting because I think what we're seeing, what I'm hearing in the mortgage market today in Canada, is that a lot of people, a lot of brokers, a lot of advisors are sort of pushing the variable rate mortgage. Hey, listen, Bank of Canada is going to cut. Why don't you just roll the dice, run with the cuts, and then lock in your variable when you see more favorable fixed rates? But, I kind of made the argument that, we're getting 5-year fixed rates down to kind of the 4.1.5. Like, I don't know. I mean, how much lower are those 5-year fixed rates going to go? Like, you're really rolling the dice to say, hey, maybe next year they're 3.5, 3.6, 3.7. There's for the 30 or 40 basis points that you might get, it might not make sense to roll the dice there. So again, predicting, rates and where the bond market's going to go is very, very difficult. So again, I just think that you're rolling the dice for what might not be a really great outcome, but we'll see. we'll see how that plays out. But that's kind of what's happening in the bond market. And number 3, we've got confirmation this week from the Bank of Canada that the loonie, the Canadian dollar, is going to be the sacrificial lamb. So, Carolyn Rogers, Deputy Governor of the Bank of Canada, she was at the Economic Council giving a presentation this week where she noted, she was asked about not only Trump getting in and, the stimulative policies that he's going to be bringing in, but the fact that, hey, listen, the Fed, they might be cutting. They're probably not going to be able to cut as much as the Bank of Canada. Carolyn Rogers, what are your thoughts? Let's clip to that comment right here.
First and most important thing to say is we set our policy rate for the Canadian economy, and there is some clear differences between their economy and our economy right now. So we have always and will continue to set our monetary policy for the Canadian economy. We have a floating exchange rate as part of our monetary policy framework. Canadian dollars priced in foreign exchange markets. That's a feature that's intended part of our monetary policy framework. It's what allows us to set monetary policy for the Canadian economy. It is a buffer to price changes. There's been a bit of worry recently about divergence, but there's a limit to that divergence. I don't think we're anywhere near that limit now. Over the years, we have seen rates between Canada and the U.S. diverge quite a bit more than they are now. So we'll see.
So take note that Carolyn Rogers says the interest rate differential between Canada and the U.S., she says, is nowhere close to the levels that concern her, that we've got a ways to go. Again, these are her words, not mine. So what that tells me is, listen, the Bank of Canada is willing to let the Canadian dollar, the loonie, sink lower in order for them to continue to lower interest rates so they can stimulate the Canadian economy, because we know the Canadian economy, particularly in the private sector, right? The corporate and the household sector is way more levered than the United States. And so they need the private sector in Canada needs that relief. She also noted in her speech, right, that 60% of all mortgages outstanding in Canada are going to face higher renewal rates over the next 12 months. So 60% of the mortgage market in Canada is going to be renewing in 2025, and they are going to see higher rates. Again, regardless of what the BOC does, we kind of have a decent idea of where the bond market's going to be. These people are going to be renewing at a higher rate, and that is going to take money out of the economy. It's money that's going towards servicing debt that would otherwise be used as consumption, and so that's a natural drag on the economy moving forward. So we got more data this week. In fact, today, the day that I'm recording, more soft data in the Canadian labor market. In terms of, what's happening there, it's just more ammo for the BOC to continue their rate cutting path. So the Canadian labor market, the 3-month rolling average for the unemployment rate, hit a new post-pandemic high in the month of October. So again, to summarize the 3 core themes that we've been talking about, the Fed is cutting, but they are much less likely to cut anywhere close to what the Bank of Canada is going to cut. And this is because the bond market is not cooperating. The bond yields are actually moving higher, which is actually tightening financial conditions. You think about U.S. fixed rate mortgages, they've actually been moving higher since the Fed cut because the bond market thinks the Fed is making a mistake, which is leading to the Canadian dollar is going to continue to move lower because the Fed is not going to be able to cut nearly as much as what the Bank of Canada is going to do. And we had confirmation this week from Carolyn Rogers at the BOC. So watch those core themes moving forward. I think it's incredibly important. What we're seeing now in the housing market is something that I talked about over the last couple of weeks. We are seeing the bounce in activity. The bounce in activity, I think, is really that mirage of a weakening currency. We're re-stimulating housing. We're re-stimulating the economy by lowering interest rates, depreciating the currency, and that is pushing housing activity higher. Greater Vancouver home sales up 32% year over year in the month of October, closer to back to like long-term averages. The months of inventory for sale down from 8 down from 8 to 5. So you're starting to see stale inventory begin to clear, months of inventory moving lower, sales activity beginning to normalize as we move into the months ahead, which is likely more rate cuts from the BOC and the sacrificial lamb, again, to reignite the economy and housing is going to be, we will all pay the price through the Canadian dollar. And I think you can see that not only in the exchange rate, you can see that in the price of gold, you can see that in the price of Bitcoin. It is all right in front of our own very eyes. So hope that helped, and we'll see you next week.